Hello everyone and welcome to my channel, where I share with you the best tips and strategies on how to grow your wealth and achieve financial freedom. In this video, I'm going to explain to you why rich people love debts, and how they use them to make more money. Now, let's get into it. What is debt? Debt is a form of borrowing money from someone else, such as a bank, a lender, or an investor. Debt can be used for various purposes, such as buying a house, starting a business, or investing in the stock market. Debt can also be classified into different types, such as secured debt, unsecured debt, short-term debt, long-term debt, etc. Debt has two main components, the principal and the interest. The principal is the amount of money that you borrow, and the interest is the cost of borrowing that money, expressed as a percentage rate per year. For example, if you borrow $10,000 at 10% interest per year, you will have to pay back $11,000 after 1 year, $10,000 in principal and $1,000 in interest. Debt can be either good or bad, depending on how you use it and how you manage it. Good debt is debt that helps you generate income or increase your net worth over time. For example, taking out a mortgage to buy a house that appreciates in value over time is considered good debt. Bad debt is debt that costs you more than it benefits you or reduces your net worth over time. For example, taking out a payday loan to buy a new TV that depreciates in value over time is considered bad debt. Why do rich people love debts? You may think that rich people don't need debts because they have enough money to buy whatever they want. However, this is not true. Rich people love debts because they use them as a tool to leverage their money and make more money. Leverage is the use of borrowed money to increase the potential return of an investment. For example, if you have $10,000 and you invested in the stock market that returns 10% per year, you will have $11,000 after 1 year. But if you borrow another $10,000 at 5% interest per year and invest it in the same stock market that returns 10% per year, you will have $22,500 after 1 year, $20,000 in principal and $2,500 in profit minus $500 in interest. This means that by using leverage, you have doubled your return from 10% to 20%. Rich people use leverage to amplify their returns and grow their wealth faster over time. They borrow money at low interest rates and invest it in high-return assets or businesses. They also use various strategies and techniques to reduce their risks and costs of borrowing, such as collateralization, diversification, hedging, tax optimization, etc. Here are some of the ways that rich people use debts to become richer. They use debts to take advantage of opportunities that they otherwise could not afford or access. For example, they can buy more properties or businesses than they have cash for, or they can invest in new or emerging markets or industries that have high potential but high entry barriers. 1. They use debts to increase their cash flow and liquidity. For example, they can use debts to refinance their existing debts at lower interest rates or longer terms, or they can use debts to fund their operating expenses or working capital needs. They use debts to benefit from inflation and currency fluctuations. For example, they can borrow money in a low inflation or low interest rate currency and invest it in a high inflation or high interest rate currency, or they can borrow money in a depreciating currency and invest it in an appreciating currency. They use debts to optimize their tax situation. For example, they can deduct the interest expenses from their taxable income, or they can use debts to create losses that offset their gains from other sources. They use debts to protect their assets from creditors or lawsuits. For example, they can use debts to create liens or encumbrances on their assets that make them less attractive or accessible to potential claimants, or they can use debts to transfer their assets to trusts or entities that are shielded from legal actions. How can you use debts like rich people? You may wonder how you can use debts like rich people and enjoy the same benefits and advantages that they do. The good news is that you don't have to be rich to use debts like rich people. You just have to follow some basic principles and best practices that can help you use debts wisely and effectively. Here are some of them. Use debts for productive purposes. Only borrow money for things that can generate income or increase your net worth over time, such as education, business, or investment. Avoid borrowing money for things that can cost you more than they benefit you or reduce your net worth over time, such as consumption, entertainment, or speculation. Use debts within your means. Only borrow money that you can afford to pay back, based on your income, expenses, assets, and liabilities. Avoid borrowing money that can put you in financial distress or hardship, such as exceeding your debt-to-income ratio, defaulting on your payments, or declaring bankruptcy. Use debts with caution. Only borrow money when you have a clear plan and a reasonable expectation of how you will use it and how you will pay it back. Avoid borrowing money impulsively or emotionally, such as following the crowd, the hype, or the fear of missing out. Use debts with discipline. Only borrow money for a specific period of time and a specific purpose, and stick to your repayment schedule and terms. Avoid borrowing money indefinitely or unnecessarily, such as rolling over your debts, paying only the minimum amount, or taking out new debts to pay off old debts. Use debts with diversification. Only borrow money from different sources and for different types of assets or businesses, to reduce your exposure and dependence on any single lender, market, or industry. Avoid borrowing money from one source or for one type of asset or business, which can increase your risk and vulnerability to any adverse event or change. However, you should also be aware of some factors that can affect or limit their debt usage, such as interest rates. These are the costs of borrowing money, expressed as a percentage rate per year. Interest rates can vary depending on the type, term, and source of debt, as well as the creditworthiness and risk profile of the borrower. Interest rates can also change over time due to market conditions and monetary policies. Higher interest rates can reduce the profitability and feasibility of using debt for investment purposes. Debt-to-income ratio. This is the ratio of total debt payments to total income per month. Debt-to-income ratio is a measure of the ability and willingness of a borrower to repay their debt obligations. Debt-to-income ratio can also affect the credit score and reputation of a borrower, as well as their eligibility in terms for obtaining new debt. A higher debt-to-income ratio can indicate a higher risk of default or insolvency. Debt-to-equity ratio. This is the ratio of total debt to total equity, or net worth, of a business or an individual. Debt-to-equity ratio is a measure of the leverage and solvency of a business or an individual. Debt-to-equity ratio can also affect the profitability and stability of a business or an individual, as well as their exposure and vulnerability to market fluctuations and external shocks. A higher debt-to-equity ratio can indicate a higher risk of bankruptcy or liquidation. Therefore, rich people use debts wisely and effectively, by balancing the benefits and costs of borrowing money for investment purposes. By following these principles and best practices, you can use debts like rich people and leverage your money to make more money. I hope you enjoyed this video and found it helpful. If you did, please give it a thumbs up and share it with your friends. And don't forget to subscribe to my channel for more videos like this. Also, let me know in the comments below what are your thoughts on debts and how do you use them to grow your wealth faster over time. I would love to hear your feedback and suggestions. Thank you for watching and I'll see you in the next video.